Alrighty. So in today's video, we are going to be talking about how to build a winning options portfolio. And this is a very important concept to really grasp and understand, because if you want to have any long-term profitability and consistency in your profits when trading options, then you need to have a winning options portfolio. You see, recently I've got a few people that have told me that, they've been trading the iron condor and the credit spreads exclusively, and they have gotten a string of losses, right? The market have gone in one direction. Recently the market has just kept going up, and they have been hit on the call side, right? Be it the iron condor, they hit on the call side, the bear call spread, they're being hit on the short call strike, and they're losing money, right? So here are two things about this. Number one, first of all, you need to understand that although this is a high win rate kind of strategy, right, roughly around 70% odd, you need to understand that there is also a 20% plus chance that you're going to lose money, right? It's not like you're going to win all the time. So it's part and parcel of trading. Number two, it also suggests that you do not actually have a proper options portfolio, because if you have a proper options portfolio, a winning options portfolio for that matter, then you're not going to be afraid where the market goes, because you're going to have positions that actually capture the market movements regardless where it goes. All right, so let me just give you a very quick example of how most people actually approach trading options. So basically they will have a watch list of stocks, and then they will shuffle through their stocks, right? And most people will actually only trade, just a handful of strategies, especially they are just starting out, which is nothing wrong, but you need to understand that it's limited in certain ways, right? So for example, maybe they are just starting out and they want to just trade only the iron condor, right? So if they trade the iron condor, then this is what's going to happen, right? They're going to go to stock A, they place on the iron condor, then they go to stock B, they place the iron condor, and then they go to stock C, they place the iron condor as well. Now, what happens is that when the market actually moves in one direction, right, there's a very strong move either up or down, this is where you're going to be tested, right? Let's say, for example, recently the market has been going up, especially for the tech stocks. So what happens is that inevitably your call side is going to be tested, right? So stock A, stock B, stock C is all going to be tested because you put on roughly at the same time, and then these are all roughly correlated stocks, right? Even though they're not correlated, if the market is, one way direction, be it up or down, you notice that it can tend to test your strikes quite a bit, right? So on the other side, let's say if the market crashes, then it's going to all be in tandem, right? You're going to be tested on your put side of an iron condor. So this is one of the problems that many people face. Now, when you get into such kind of situations, you're pretty limited, because this type of strategies actually only take advantage if the market stays in the expected range, right? Or rather the expected move. If it goes outside the expected move, which it does and will at certain times in point when you trade it long enough, then you're going to be tested, right? Especially if you get into the position, right? If you're unlucky, you start trading iron condors when the market starts to make a big move, right? That's when you're going to get tested. So when you're only trading such kind of spreads, be it, right, iron condor, or even if you're just trading, the credit spreads, for example, you only put on the put spread. If the market crashes, then it's all going to test your put spread. Then you're going to wonder, if this strategy is going to work or not. But the thing is this, if you have a proper winning options portfolio, you're not going to be afraid even though it tests your put side, because you also have other positions that will take advantage if the market actually goes down or up above the expected move. So here's what I mean. To have a winning options portfolio at any single time, you want to have a combination of strategies that captures profits regardless of where the market goes, right? So if the market stays within the range down here, you don't have to worry, because you have something to capture this profit, which is staying in the middle. But at the same time, if the market goes above, you're going to have something to capture profits as well. And at the same time, if the market goes all the way down, you're going to have something that captures profit as well. So this is what I want you to think about when you're building your options portfolio. So first off, the first strategy most people have in their arsenal is what we call the neutral strategies, right? Neutral strategies are also what you would consider income strategies, right? So income strategies are basically strategies that will profit when the market stays inside of the expected range, right? These are the strategies where most of the people actually get started with. A lot of people talk about this as well. So these strategies are something like the iron condor or the strangle. So the iron condor and strangle are basically very similar strategies, just that the iron condor is the defined risk version. Strangle is the undefined risk version. Then you have your Jade Iron Condor. A Jade Iron Condor is the defined risk version, and the Jade Lizard is the undefined risk version. Then we have the short put as well. Now the short put, I put it as a neutral strategy as well. It's neutral to bullish, because if you have a short put, let's say for example you sell a short put down here, if the market goes below this short put strike, then it's going to lose money. So I put the short put as a neutral kind of a strategy, because if the market actually goes below the short strike, it's going to lose money, right? Short put, you do not want it to actually exceed the expected move. Now for the credit spread, it's similar as well. Credit spreads, whether you have it below or you have it above, basically you only want the market to stay inside the expected move and not to exceed, your short call strike or your short put strike. So again, I put this under neutral strategies, because again, these are strategies that will only really profit if it stays inside the expected move. Now here is the big questions. What do you do if the market actually goes below this point, right? Let's say for example, now the market goes below our expected move. If it goes below our expected range, what will happen is that all these strategies will tend to lose money, right? The Iron Condor will lose money, your Jade Iron Condor is going to lose money, short put is going to lose money, your bull put spread is going to lose money. So what do? So this is where you need to have some bearish strategies that profit from the market going below the expected range or the expected move. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So these are the times where we anticipate where there's going to be a huge adverse move to the downside, or even maybe a market crash. So what are these bearish strategies that can help you, capture profits if the market goes down? So such strategies I would consider is the put ratio spread, the put broken wing butterfly, and also the put diagonal spread, right? So for the put ratio spread and the put broken wing butterfly, they're pretty much similar strategies. It's just that one is undefined, the other one is defined. So the put ratio spread and the put broken wing butterfly is a very unique strategy, because you can design it in a way whereby if the market actually goes outside of the expected range, this is where you can actually make your max profit, right? So that is why I like to design it in a way whereby I tend to actually make more if the market goes down. Now, of course, there is a point whereby if it goes past the break-even point of your put ratio spread or the put broken wing butterfly, it's going to lose money, yes, of course. But on the upside is that if the market actually goes up, it doesn't lose any money at all, but it's still profit, right? So the way you want to design this bearish strategy, or rather this put ratio spread and the put broken wing butterfly, is that you want to make it as bearish as possible, so that, if the market stays somewhere in the neutral zone, you actually do not make that much money, just a minimum credit. It's only when it exceeds your expected range, the 1 standard deviation move, that's when you have a chance or the opportunity to actually hit the max profit, right? So if you're not sure how to construct this, I've also created videos on this in my channel. Just go ahead and just browse them on my channel, all right? Now, alternatively, if you want something that actually makes more as the market goes down, this is where you want to consider putting on the put diagonal spread, right? Put diagonal spread is a very pure bearish strategy, whereby the more the market goes down, the more you're going to make, right? Of course, limited by where your short put at, right? So this is a put diagonal spread, but the general census is that this diagonal spread can be a very good hedge for any neutral strategies which you have. So if the market goes down, at least your put diagonal spread can still make some money, right? So remember, all these positions all have different DTE, so they are all going to take profit at different points in time in the future, right? So maybe you have your neutral strategies, right? Temporarily, they could be losing some money, but then the put diagonal spread, you could be taking profit on that. And when the market goes back up again, then you have your neutral strategies making money again. Now, what happens if the market goes up instead right now? What if the market goes past the expected range? So again, if you have any neutral strategies, it's going to get hit, right? Like I've got people that have reached out to me telling me, say that they put on the Iron Condor and they've been hit on the QQQs or the SPYs, right? As the market kept going up. So the thing is that you do want to actually have some bullish strategies in place already, because if you already have some bullish strategies in place, then you're not going to be afraid, because if the market goes up, then guess what? You actually have some positions that actually can capture profits if the market goes up, right? So what are the bullish strategies? Well, there are the leaps. These are long-term leaps. So I actually do have quite a number of leaps, especially also on the index ETFs like the QQQs. Alternatively, you can also put on the poor man's cover call, which is also known as the call diagonal spread. Basically, the poor man's cover call is a lips plus covered call, right? So it's pretty much an extension of the lips. And if you have sufficient capital, then you want to also consider putting on the income grid wheel strategy, right? I've already got a number of videos on the income grid wheel strategy on my channel as well. If you haven't watched them, just go ahead to my channel to watch them. But basically, when you have this on, you notice now you're no longer afraid if the market goes up, right? For example, the person who reached out to me told me, they put on iron condor, they get hit on the call side, they're losing money. Hey, if you already have some of these bullish strategies on, you actually are excited. Why? Because while you may be losing money on your neutral strategies, your iron condor, you're going to be making quite a bit based on your long-term bullish strategies, right? Mid to long-term strategies like your leaves, poor man cover call, your income grid build strategy. And the best situation would be, if the market goes up, then you take profit on some of these positions which you have the bullish strategies, then the market goes back down. And this is where your neutral strategies start to profit as well. So as you can see, they are all profiting at different points in time. So that is why it is very important for you to build a winning options portfolio. So when you have a winning options portfolio, you have your neutral strategies, you have your bearish strategies, and you have your bullish strategies, then you do not have to be worried about where the market goes to. The market can go up, the market can go sideways, the market can go down. You're not going to be afraid because you already have positions that are going to capture profits regardless where the market goes to. So think about how you can build a winning options portfolio for yourself. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.